Picture this. Your daughter calls you on a Sunday afternoon. She sounds upset. She just got off the phone with her accountant. You passed away 2 years ago in this scenario. Stay with me here. And she inherited your IRA. The account you spent 30 years building. The account you always told her would be her financial safety net. Her accountant just told her that because she did not take any distributions in the first 2 years after inheriting, she now owes a 25% penalty on the amount she should have withdrawn. On top of the income taxes, she still owes on every dollar she takes out. And if she waits until year 10 and pulls out the full balance at once, the way she planned, she could lose a third of that inheritance to federal income taxes in a single year. The account you thought would take care of your family is now taking care of the IRS instead. Here is the thing. This is not a worst-case scenario. This is happening to families right now across the United States, and it is happening because of a law that changed in 2019, a law that most seniors and their children still do not fully understand. If you have an IRA, if you plan to leave it to your children or grandchildren, you need to watch this video all the way through, because what you do or do not do in the next few years will determine how much of your life savings actually reaches your family. I am Jocelyn. I am a senior policy analyst and retirement finance expert, and this channel exists to make sure you understand the rules that affect your retirement savings, your Social Security, and your family's financial future before those rules cost you something you cannot get back. Today, we are talking about one of the most significant and most misunderstood changes in retirement law in the past 30 years. It is called the 10-year rule. It was created by the Secure Act. And it has fundamentally changed what happens to your IRA when you pass it on to your children. I am going to explain exactly what this rule says, who it affects, what the 2028 deadline specifically means, and what you can do right now to protect your family's inheritance. But I need you to stay until the very end, because there is a hidden mistake. It's a very specific, very common mistake that is costing families tens of thousands of dollars in unnecessary taxes. And I'm going to tell you exactly what it is and how to avoid it. Let me start with a story. I want to tell you about Richard. Richard is 71 years old. He lives in Phoenix, Arizona. He spent 34 years working as a civil engineer. He saved diligently throughout his career. By the time he retired, he had built a traditional IRA worth just over $400,000. Richard was proud of that account. He talked about it often. He told his son, Michael, that it was his legacy, the financial cushion that would help Michael and his family get through any rough patch life might bring. Richard passed away in 2020. Michael inherited the IRA. At the time, Michael's accountant gave him some general guidance. She told him the money needed to come out within 10 years. She told him he had until 2030. What she did not explain clearly, because even many professionals were confused in those early years, was that because Richard had already started taking his required minimum distributions before he died, Michael was also required to take annual distributions from the inherited IRA every single year from 2021 through 2029, not just by the end of year 10, every year, starting in year 1. Michael did not take a single distribution in 2021. He did not take one in 2022. He assumed he had flexibility. He assumed the IRS was giving people a grace period. He was right, but only partially. The IRS had waived penalties for missed annual distributions for 2021, 2022, 2023, and 2024. What Michael did not know was that this transition relief ended on December 31st, 2024. In 2025, Michael missed his annual distribution again. This time, there was no waiver waiting for him. The IRS sent him a notice. He owed a 25% excise tax penalty on the amount he should have withdrawn. In his case, that was thousands of dollars, on top of the income tax he owed. And then Michael's accountant ran the numbers for 2030, year 10. If Michael took no more distributions between now and then, he would need to withdraw the entire remaining balance in a single year. At his income level, that withdrawal would push him into the 32% federal tax bracket on a substantial portion of the money. His father's $400,000 legacy could end up costing the family over $140,000 in taxes. Richard did everything right. He saved for decades. He built real wealth. But because no one explained the new rules clearly, and because Michael did not know the questions to ask, a significant portion of that inheritance is heading to the IRS. Richard's story is fictional, but the rules that created this situation are completely real, and they are affecting families in every state in this country right now. Let me give you the complete facts. Everything I am about to tell you comes directly from IRS.gov, the IRS final regulations published in 2024, and verified resources from AARP and the Consumer Financial Protection Bureau. No speculation, just the official rules explained clearly. The law, what changed and when. On December 20th, 2019, the Secure Act was signed into federal law. Then, on December 29, 2022, the Secure 2.0 Act was signed as part of the Consolidated Appropriations Act of 2023. Together, these two laws fundamentally changed how inherited IRAs work for most non-spouse beneficiaries. The change was enormous, and millions of Americans, seniors who are still planning their estates and children who have already inherited accounts, are operating under the old rules without knowing it. What the old rules said: the stretch IRA. Before the Secure Act, non-spouse beneficiaries could take distributions from an inherited IRA spread out over their own life expectancy, their entire lifetime. If a 40-year-old child inherited a parent's IRA, they could stretch distributions over 40 or 50 years. The account kept growing tax-deferred. The annual tax burden was small and manageable. This strategy was called the stretch IRA. It was one of the most powerful estate planning tools available to American families. The Secure Act eliminated it. For deaths occurring on or after January 1st, 2020, the stretch IRA is gone for most non-spouse beneficiaries. What the new rules say. The 10-year rule. Under the new law, most non-spouse beneficiaries who inherit an IRA on or after January 1st, 2020, must withdraw the entire account balance within 10 years of the original owner's death. This applies to adult children inheriting a parent's IRA. It applies to grandchildren. It applies to other non-spouse individual beneficiaries. And it applies to certain trusts. The 10-year deadline is hard. It is not flexible. The entire account, every dollar, must be out by December 31st of year 10. Who is still exempt? Now let me tell you who is still protected under the old lifetime stretch rules. These are called eligible designated beneficiaries. There are 5 categories: surviving spouses, minor children of the original IRA owner, but only until they reach the age of majority, at which point the 10-year clock begins, disabled individuals as defined under IRS code, chronically ill individuals, and individuals who are not more than 10 years younger than the deceased IRA owner. If your beneficiary falls into one of these categories, the 10-year rule does not apply to them. But if your son or daughter is a healthy adult, which describes most people, the 10-year rule applies to them fully. The annual distribution requirement, the hidden layer. Now here is where it gets more complicated, and this is the piece that caught Michael in our story. In July 2024, the IRS issued final regulations confirming a critical detail that had been unclear since 2020. If the original IRA owner had already begun taking required minimum distributions before they died, their beneficiaries must take annual distributions in years 1 through 9 of the 10-year period based on the beneficiary's life expectancy using the IRS single life expectancy table, and then withdraw whatever remains by the end of year 10. If the original IRA owner died before their required beginning date, meaning they had not yet started RMDs, beneficiaries must still empty the account by year 10, but they are not required to take annual distributions in years 1 through 9. They have more flexibility in timing. The required beginning date under current law, under Secure 2.0, is April 1st of the year after the IRA owner turns 73. For those born after 1959, the age will eventually be 75. The transition relief that ended. From 2021 through 2024, the IRS granted transition relief. They waived penalties for beneficiaries who missed required annual distributions within the 10-year window. Many people, and even some financial professionals, assumed this relief was permanent. It was not. The transition relief period ended on December 31st, 2024. The IRS final regulations became fully effective January 1st, 2025. Starting with tax year 2025, missing a required annual distribution within the 10-year window triggers a 25% excise tax penalty on the amount that should have been withdrawn. That penalty can be reduced to 10% if the mistake is corrected within a 2-year window. The 2028 deadline, what it specifically means. Now let me explain specifically what the 2028 deadline refers to. Beneficiaries who inherited IRAs in 2018 under Pre-Secure Act rules, that were subsequently converted to 10-year treatment under certain transition provisions face their final complete withdrawal deadline on December 31st, 2028. If you or a family member inherited an IRA in 2018 and has been operating under the assumption that there is plenty of time remaining, the final deadline is less than 3 years away. Every dollar must be out of that account by December 31st, 2028. For context, beneficiaries who inherited in 2020 under the new Secure Act rules face their deadline on December 31st, 2030, and those who inherited in 2021 face a 2031 deadline. The 10-year clock runs from the year of the original owner's death. The tax bomb. Why timing matters so much. Distributions from an inherited traditional IRA are subject to ordinary income tax in the year they are received. They are not subject to the 10% early withdrawal penalty, but they are fully taxable as regular income. If a beneficiary waits until year 10 and withdraws a large balance all at once, that single withdrawal can push them into the 32 or 35% federal tax bracket on a substantial portion. A $400,000 withdrawal in a single year could generate $140,000 or more in federal income taxes. Compare that to strategic distributions spread across all 10 years, or at minimum across multiple lower income years within the 10-year window. Spreading distributions can keep the beneficiary in a lower tax bracket each year and dramatically reduce total lifetime tax paid. A child who inherits a $500,000 traditional IRA and withdraws it all in year 10 may lose $150,000 to $185,000 or more in federal income taxes. The same Roth IRA, if the original owner had converted, would generate zero federal income tax on distributions, assuming the 5-year holding period was met. The Medicare IRMAA connection. There is one more consequence that most people completely overlook. A large inherited IRA distribution in a single year dramatically increases modified adjusted gross income. And Medicare uses MAGI from 2 years prior to calculate Part B and Part D premium surcharges, called IRMAA. If a beneficiary who is already receiving Medicare takes a $300,000 inherited IRA distribution in 2025, they could face significantly higher Medicare premiums in 2027. In 2026, IRMAA surcharges can add up to $443.90 per month to Medicare Part B premiums for the highest income brackets. That is over $5,000 a year in additional Medicare costs, triggered by a single large IRA withdrawal. The Social Security taxation connection. Large inherited IRA distributions count as ordinary income. For beneficiaries who are also receiving Social Security, this additional income can push them above the thresholds at which Social Security benefits become taxable. Up to 85% of Social Security benefits become taxable when combined income exceeds $34,000 for single filers and $44,000 for married couples filing jointly. A well-timed, well-managed distribution strategy from an inherited IRA can help beneficiaries avoid these triggers. A poorly planned strategy can create a chain reaction of tax consequences that eats away at the inheritance from multiple directions simultaneously. The trust problem. One final point before we get to the action plan. Many seniors named a trust as their IRA beneficiary, often specifically to enable the stretch IRA strategy. If that trust does not qualify as a see-through trust under current IRS rules, the entire IRA may be required to be distributed within 5 years, not 10. Outdated trust documents written before the Secure Act can accelerate the tax burden significantly rather than protect against it. And beneficiary designations on IRA accounts override wills. Whoever is named on the IRA beneficiary form receives the account, regardless of what a will says. If your beneficiary designations are outdated, if they name a deceased spouse, an ex-partner, or an estate rather than a living individual, the consequences can be severe. All right, you now understand what is at stake. Let me give you the 3 steps you need to take, starting this week. Step 1. Review and update your IRA beneficiary designations immediately. Contact your IRA custodian, the bank, brokerage, or financial institution that holds your IRA, and request a copy of your current beneficiary designation form. Read it carefully. Ask yourself these questions. Is the named beneficiary still alive? Is it still the person you want to receive the account? Have you been through a divorce, a death in the family, or the birth of grandchildren since you last updated this form? If your estate is named as beneficiary instead of a specific individual, this is urgent. An estate inheriting an IRA does not qualify for the 10-year rule. It may be subject to even shorter distribution windows of 5 years or less. If you want a disabled child to qualify as an eligible designated beneficiary and use the lifetime stretch rule, make sure the designation is structured correctly and that the disability is properly documented under IRS criteria. Update the form, get confirmation in writing, keep a copy for your records. This single step can protect hundreds of thousands of dollars and make the difference between your family receiving your full legacy or losing a significant portion of it to the IRS. Step 2. Develop a 10-year distribution strategy right now. Do not wait until year 10. If you are a beneficiary who has already inherited an IRA, do not make the mistake of assuming you can wait until year 10 to deal with it. First, determine whether you are required to take annual distributions in years 1 through 9. The key question is this: had the original IRA owner begun taking required minimum distributions before they died? If yes, you must take annual distributions in each of years 1 through 9. If no, you have more timing flexibility within the 10-year window. Second, consult the IRS Single Life Expectancy Tables in IRS Publication 590B to calculate your required annual distribution amount. This document is available completely free at irs.gov, pub, IRS PDF, P590B.pdf. I will put the link in the description below. Third, think carefully about timing. If you are in a lower income year, perhaps due to retirement, reduced work hours, or other deductions, this may be an ideal year to take a larger distribution and reduce the balance remaining for later years. Spreading distributions intelligently across the 10-year window can save your family tens of thousands of dollars. If you missed required annual distributions in earlier years, do not panic. You can still correct this. Take the missed distribution as soon as possible. File IRS Form 5329 with your tax return. Attach a written letter explaining the reasonable cause for the missed distribution, and request a waiver of the 25% excise tax. The IRS has historically granted these waivers for reasonable cause, and if you correct the mistake within the 2-year correction window, the penalty automatically reduces from 25% to 10%. Step 3. Consider a Roth IRA conversion to protect future beneficiaries. If you are the IRA owner and you want to protect your children from the inherited IRA tax bomb, the most powerful strategy available to you right now is a Roth IRA conversion. Here is how it works. You convert all or part of your traditional IRA to a Roth IRA. You pay ordinary income tax on the converted amount in the year of conversion. But after that point, the Roth IRA grows completely tax-free. And when your children inherit it, their distributions are generally tax-free as well. The 10-year rule still applies. The account must be emptied within 10 years, but there is no income tax on those distributions. Converting in lower income years, converting gradually over multiple years rather than all at once. Using a qualified charitable distribution of up to $105,000 per year directly from your IRA to a qualified charity, which reduces your taxable IRA balance before death and satisfies your own RMD requirement. These are all legal strategies that can significantly reduce the tax burden your family faces after you are gone. For free help reviewing these options, contact AARP TaxAid at arp.org/money, taxes, AARP TaxAid. They provide completely free tax counseling specifically for people age 60 and older. The Consumer Financial Protection Bureau also offers free retirement planning tools at ConsumerFinance.gov, Consumer Tools Retirement. I will link both resources in the description. Let me be completely direct with you for just a moment. The rules I just explained, the 10-year rule, the annual distribution requirement, the IRMAA connection, the trust problem, the Social Security taxation trigger, none of these are simple. None of them are written in plain language by the IRS. They are buried in publications, final regulations, and technical notices that most people will never read on their own. And yet the financial consequences of not understanding them are devastating. A family that built $400,000 in retirement savings over 30 years can lose $140,000 of it to taxes. Not because they did anything wrong, but because no one explained clearly that the rules changed in 2019. That is not acceptable, and it is exactly why I make these videos. But here's something I need to be honest with you about. YouTube is a wonderful platform, but the algorithm controls what you see. Notifications do not always reach you. A critical IRS regulation can change, a new deadline can emerge, a new law can pass, and you might not see a video about it for weeks, or you might never see it at all. The 2028 deadline is real. More IRA deadlines are behind it. Tax laws are changing. Estate planning rules are evolving. And the window to act, to convert your IRA, to update beneficiary designations, to develop a smart distribution strategy is not unlimited. So I have built something designed to make sure you never miss information that matters to your family. Click the link in the description right now and join the Global Senior Alerts official WhatsApp channel. When you join, you will immediately be able to download a completely free senior benefits protection guide. This guide covers inherited IRA rules, Social Security strategies, Medicare cost protections, pension tax rules, banking regulations for seniors, and more, all written in plain, clear language that you can actually use and act on. You will also receive real-time alerts sent directly to your phone the moment a major rule change happens that affects your retirement savings, your benefits, or your family's financial future. Not a week later when a video finally reaches your feed, right when it matters, so you have time to respond before a deadline closes. No spam, no sales pitches, no political content, just verified, timely information from official government sources delivered directly to you when you need it most. Because here is what I have learned after years of working in this space. The people who protect their family's inheritance are not the ones who are wealthier or more educated or luckier. They are the ones who got the right information at the right time and took action on it. That is the only difference. And that is exactly what I am here to give you. Share this video right now with someone you care about who has an IRA or who may inherit one someday. A spouse, an adult child, a sibling, a close friend. They need to understand these rules before the deadlines arrive, not after the damage is already done. And if this video helped you, please subscribe to this channel and turn on notifications, because the next video may contain the one piece of information that protects your retirement in a way you never anticipated. I am Jocelyn. Thank you so much for watching. Thank you for trusting this channel with your time and with your family's financial security. Take care of yourself and take care of the people you love.